Visa ticker V is currently trading at $226.50, and over the past month, the company is down by 0.2%, and over the past 6 months, the company is up by 4.06%. When we jump to tip ranks, we can see that the analysts currently project the price of $272 by the end of 2023, which is a 20.4% upside for Visa, with the highest price target of $300 per share by the end of 2023. And of course, Visa has 18 buy ratings, only 1 hold rating, and 0 sell ratings. When we jump to the monthly full, we can see that Visa is currently trading at 33 times its trailing 12-month earnings, which is on the cheaper side of where it typically trades. Now, for most companies, trading at their 33 times trailing 12 months earnings would make them overvalued. However, Visa's track record of revenue and earnings growth make it trade at a premium. Now, Visa currently has a dividend yield of only 0.5%, which is below average. However, Visa has a very strong average 13 to 15% annual dividend growth rate and a very low payout ratio, giving Visa plenty room for future dividend growth, something that every value investor is looking for in their company. Now, to value Visa in a bit more depth, we will jump over to our valuation spreadsheets, where we will have a look at the 9-pillar analysis and calculate the intrinsic value of Visa using the Graham's formula revised, discounted cash flow model, multiples valuation model, and the dividend discount model, where all these models will lead to our ultimate valuation at the end of the video. Now, when we jump back to the stock screener, right away we can see that the current dividend yield for Visa is actually 0.8%, with a dividend payout of $1.8 per share per year and a very low trailing payout ratio of only 21.2%. When we have a look further down, we can see that the institutional ownership of Visa is sitting at 99% and the beta is sitting at 0.97, which is very close to 1, meaning that with Visa you will see very similar volatility as you would with the overall market. Now we can jump to the 9-pillar analysis, where right away we can see that the rating for Visa is sitting at 7 out of 9, with the 5-year PE ratio and the price to free cash flow being the only 2 pillars in the red. Now we generally like the 5-year PE ratio to be below 22.5, as that would mean that a company is undervalued. When the 5-year PE ratio is above 22.5, it technically means that the company is overvalued, which would be the case with Visa. But as we have stated before, Visa has a very good track record of revenue and earnings growth, which make it trade at a premium. Now we also want the 5-year profit margin to be above 10%. Visa's profit margin is sitting at 83.5%, a very good profit margin indeed. Now for the next 3 pillars, we want there to be net income, revenue, and free cash flow growth over the past 5 years. And as we can see, all have been increasing by more than 10% year over the year over the past 5 years. For the next pillar, we want there to be decreasing shares outstanding, and Visa has actually been buying back shares at a very high rate. Now this is great in the eyes of every value investor, as when there are less shares outstanding, you essentially own a larger portion of the company. Now for the next pillar, we want the long-term liabilities of the 5-year free cash flow negative dividends to be below 3. This pillar gives us insight of how much time a company needs to pay off all their long-term liabilities using their historical free cash flow negative dividends. For Visa, this value is sitting at 0.54, meaning that Visa can pay off their long-term liabilities in about 2 to 3 years. And finally, we can see that Visa has indeed been increasing their dividend by almost 20% year over year. But now we can jump to our first valuation model, which is the Graham's formula revised. Here we plug in the earnings per share of our company, Visa in this case, plug in the base PE, 5-year growth estimate, growth rate multiplier, average yield on AA corporation bonds, and the current yield on AA corporation bonds to get an intrinsic value of $135.91, 67% lower than the current trading price of Visa. Now, one of the reasons for such a low intrinsic value using this model is the current yield on AA corporation bonds, which is currently sitting at 4.52, but in the long run, this would be sitting at about 3.5. So if we plug that in, we can see that we get an intrinsic value of $175.51. And we can jump to the next valuation model, which is the discounted cash flow model. Here we plug in the free cash flow over the past 10 years and calculate the average growth rate to be sitting at 33.30%. Now for the next many years, I calculated a growth rate of 10% year over year. And using this growth rate, I calculated the future free cash flow over the next 10 years and the terminal value. And the terminal value is the free cash flow after 2031 in this case. Now to move forward with the valuation, we need to calculate the present value of that future free cash flow, and we do that using the discount rate, which is currently sitting at 8% for Visa. When we plug in the discount rate, we calculate the present value of the future free cash flow and the present value of our terminal value. We then sum up all the future free cash flow, add any current cash and cash equivalents, subtract total debt, and get an equity value of $509 billion, which we divide by the shares outstanding and get an intrinsic value of $315.15, indicating that Visa does have outstanding free cash flow growth rate. But now we can move to our third valuation model, the multiples valuation model. Here I will be comparing Visa to MasterCard and Fiserv. I took these companies' current stock prices and divided by their current earnings per share to get their price to earnings ratio. I then average out this price to earnings ratio to arrive at an average PE of 33.44. I then multiply that by the earnings per share of Visa and got an intrinsic value of $250.46, indicating that Visa might indeed be undervalued compared to companies which operate in the same sector. Now, if we move to our final valuation model, which is the dividend discount model, we plug in the dividend payout over the past 5 years and calculate the average growth rate to be sitting at 15.85%. Now, thanks to Visa's very low trailing payout ratio, I project a growth rate of 15% over the next few years. And using this, I calculate the next year's dividend to be sitting at $1.98 per share per year. Now, of course, when we use the dividend discount model and the projected growth rate is higher than the WACC of the company, we get a negative intrinsic value. And therefore, I have my alternative dividend discount model where I plug in the next year's dividend, the stock price next year projected by analysts all over the world, and the WACC of the company to arrive at an intrinsic value of $246.16. Again, quite higher than the current trading price of Visa. But now we can jump to our ultimate valuation, where we average out the Graham's formula revised, multiples valuation, discounting cash flow valuation, and the alternative dividend discount model valuation to arrive at an intrinsic value of $246.82, about 9% higher than the current trading price of Visa. Now when we plug in a margin of safety of 15%, we would get an acceptable buy price at $209.80. But as I do believe that Visa should be trading at a premium, if I plug in a margin of safety of say only 6%, we would get an acceptable buy price at $232.01, which would indeed be a buy at Visa's current trading price. With that, I do believe that Visa has a very bright future ahead of itself, with their increasing dividend, their low trailing payout ratio, and their very nice free cash flow, revenue, and net income growth rates. With that, if you'd like to download these spreadsheets, you can do so at my Patreon at the link in the description. Don't forget to like the video and consider subscribing if you want to see more valuations like this.